9 out of 10 African infrastructure projects never reach financial close.
90%.
90%. They are sourced. They are developed. They consume years of work and millions in preparation costs, and they never reach funding.
Why?
Not because the projects are bad. Not because the markets are weak. Because the projects are not bankable.
That one word, bankable, is the difference between a project that gets built and one that dies on a shelf.
Welcome to AIB Corp Ltd. I am Zara, Senior Advisory Specialist. And this is what we do. We turn African infrastructure projects into investment-ready propositions.
Let us start with the definition. What does bankable actually mean?
A bankable project is a structured, de-risked, revenue-generating proposition that a lender or investor is confident will generate sufficient cash flow to service debt, cover operational costs, and return acceptable profit within an acceptable risk profile.
So it is not just about having a good idea.
An idea has no value in project finance. What has value is evidence, contracts, legal standing, a financial model that survives scrutiny.
How do funders actually evaluate a project?
At AIB, we have identified 5 investment decision factors that every serious funder, whether a development finance institution, a private equity fund, or a commercial bank, applies before committing capital.
What are they?
1. Partner and sponsor risk. Who is behind this project, and do they have the track record to execute it? 2. Legal and regulatory standing. Is the project properly structured in its jurisdiction? 3. Country and political stability. Does the operating environment support long-term investment? 4. Profitability and return profile. Does the financial model stack up to a debt service coverage ratio the market accepts? And 5. ESG alignment. Environmental, social, and governance compliance, including IFC Performance Standards and the Equator Principles.
These are not just boxes to tick.
No. A gap in any one of them is enough for a DFI credit committee to decline. That is why most projects fail, not in the field, but in the boardroom.
So how do you build a project that passes all 5 factors? What are the 5 pillars of a bankable project?
Pillar 1, viable revenue model. This means contractual revenue, not projected, not hoped for. Power purchase agreements, off-take contracts, government concession agreements, service-level agreements backed by creditworthy counterparties.
Not a spreadsheet assumption.
A funder needs to see signed paper. Without a credible revenue contract, there is no basis for debt sizing.
Pillar 2.
Pillar 2, a strong management and sponsor team. In African project finance, the sponsor's track record carries enormous weight. Who has developed a similar project before? Who is the EPC contractor? Who is the operator? Funders are backing people as much as projects.
They want to see execution capability.
And skin in the game. Equity participation from the sponsor signals commitment. If you are not willing to risk your own capital, why should they risk theirs?
Pillar 3.
Pillar 3. Robust financial model. This is where most African projects are weakest. Your model must produce a debt service coverage ratio, DSCR, of at least 1.3 times under base case projections.
What does DSCR mean in simple terms?
For every $1 of debt repayment, your project must generate $1.30 in cash flow. That buffer is what gives a lender confidence that even in a downside scenario, their loan is repaid.
And stress testing?
You must model a revenue reduction of 20 to 30%, cost overruns of 15 to 20%, currency depreciation, and your project must still show positive DSCR. If it cannot survive those scenarios on paper, it will not survive them in real life.
Pillar 4.
Pillar 4. Regulatory and legal compliance. In Africa, this is where deals collapse most frequently. Environmental and social impact assessment, the ESIA, land tenure and title deeds, permits and construction licenses, off-take counterparty solvency, community consultation records.
And IFC Performance Standards?
The IFC's 8 performance standards are the international benchmark for environmental and social due diligence. If your project is seeking DFI capital from the African Development Bank, IFC DEG, Proparco, Your ESIA must meet these standards. There is no negotiating around them.
And Pillar 5?
Pillar 5. Risk Mitigation. From AIB's analysis of over 100 African infrastructure transactions, the most effective risk instruments are political risk insurance, covering 36% of DFI-backed deals. MIGA and World Bank guarantee products at 30%, sovereign guarantees at 21%, and contractual structures, PPAs and concession agreements, at 15%.
So a properly structured project has multiple layers of protection.
That is the point. No single instrument covers everything. You stack them to bring the risk-adjusted return to a level that the market accepts.
Let us talk about the journey. What does a project actually go through to reach financial close?
6 stages. Stage 1. Identification and concept development. Feasibility, market validation, initial structuring. Stage 2. Pre-feasibility. Technical scoping, preliminary financial model, regulatory mapping. Stage 3. Full feasibility and due diligence. ESEA, full financial model, legal structuring, mandate agreements with advisors. Stage 4. Transaction structuring, SPV formation, term sheet negotiation, investor targeting. Stage 5. Financial close preparation, final documentation, conditions precedent, credit committee approvals. Stage 6. Financial close, debt and equity drawdown, construction commencement.
What is an SPV and why does every bankable project need one?
A special purpose vehicle is a ring-fenced legal entity created specifically for the project. It holds all project assets, contracts, and liabilities. It is isolated from the sponsor's balance sheet. Lenders lend to the SPV, not the sponsor. It provides legal clarity, governance structure, and limits cross-default risk.
And the project structures, BOT, PPP, blended finance?
Build, operate, transfer is used for toll roads, ports, and energy concessions. The private sector builds, operates for a concession period, then transfers the asset to government. Public-private partnerships spread risk between public and private balance sheets. Blended finance combines concessional capital from DFIs with commercial equity to reduce the cost of capital and unlock deals that would not be commercially viable alone. EPC+F, engineering, procurement, construction plus financing, integrates the construction contract with a financing solution.
ESG keeps coming up. Is this just a box-ticking exercise for African projects?
Not anymore. The African Development Bank, IFC, and every major DFI now embed ESG performance covenants into loan agreements. If your project underperforms on environmental or social metrics post-close, you trigger a covenant breach.
And SDG alignment?
Projects that demonstrate clear alignment with UN Sustainable Development Goals, particularly SDG 6 for clean water, SDG 7 for clean energy, SDG 9 for infrastructure, SDG 13 for climate action, and SDG 17 for global partnerships, access a wider pool of impact capital and concessional finance.
That is not just corporate language. It directly affects access to capital.
It determines eligibility for entire classes of funding: green bonds, climate finance facilities, the Global Infrastructure Facility. If your project cannot map to these frameworks, you have excluded yourself from a significant portion of the available capital pool.
Where does the money actually come from for African infrastructure?
The primary sources are development finance institutions, the African Development Bank, the International Finance Corporation, DEG, Proparco, British International Investment, and the U.S. Development Finance Corporation. These are the anchor lenders for most large-scale African infrastructure. Then private equity, sector-specific Africa infrastructure funds, which have grown significantly over the last decade. Commercial banks, primarily Pan-African banks like Standard Bank, Rand Merchant Bank, Ecobank, and ABSA, who understand African jurisdiction risk. Blended finance facilities from multilaterals. And diaspora capital, the African diaspora remits over $100 billion annually. Structured investment vehicles can direct a portion of that into bankable projects,
So the capital exists.
Hundreds of billions of dollars are actively seeking bankable African infrastructure projects in energy, water, healthcare, housing, and digital infrastructure. The constraint is not capital, it is deal flow. It is the absence of investment-ready projects.
That 90% attrition rate.
From 100 projects sourced, 20 reach post-feasibility, 10 reach financial close. If you can build a project that belongs in that 10%, the capital will find you.
Let us give viewers something actionable. What is the bankability checklist?
5 questions. 1. Do you have a contractual revenue stream, not a projection, a signed agreement? 2. Does your management team have a verifiable track record in this sector? 3. Does your financial model show DSCR above 1.3 under stress scenarios? 4. Is your legal and regulatory position clean, ESIA completed, permits in place, land tenure documented? 5. Have you identified your key risks and structured instruments to mitigate each one? If you cannot answer yes to all 5, you are not ready for the funder's table.
But you can get ready.
That is exactly what project development is. A structured process of building evidence, reducing risk, and creating the documentation that converts a viable idea into a fundable transaction.
For project developers watching this, where do you start if you are at the concept stage?
Start with your concept note, 1 to 2 pages. Problem, solution, market, team, ask. Get external validation before you spend money on a full information memorandum.
And if you need professional support at any stage?
AIB Corp Ltd, African Infrastructure Building, Corporate Limited, provides end-to-end project development and advisory services across the continent. From concept structuring and feasibility assessment, through financial modeling and investor documentation, to transaction advisory and DFI engagement. Our fee structures are designed for the African project development context, retainer and success fee arrangements that align with the realities of African budgets. We offer a confidential initial consultation for qualifying projects. You can reach our advisory team through our website at du.aibcorpltd.com.
Knowledge first, then the right structure, then the right partners.
That is the path to financial close. And that is what this channel is here to teach, every single week.
If this gave you a clearer picture of what bankable really means, subscribe now. Every week, AIB Corp Ltd breaks down the frameworks, the structures, and the strategies that African infrastructure projects need to attract serious capital.
Subscribe. Share this with a project developer who needs to hear it. Visit us at du.aibcorpltd.com and leave a comment. What sector are you developing in? We read everyone.